A massive wall of money, over $7.3 trillion, is sitting on the sidelines, and experts believe it's about to flood into crypto, potentially kicking off an epic altcoin season with 20-30x gains. While traditional finance guys are calling Bitcoin dumber than crap, institutional demand is surging with record ETF inflows. Technical charts are flashing a historical buy signal that previously led to exponential pumps, with analysts targeting $118,000 for Bitcoin next. The weird thing? This is all happening because of bad economic news. Rising unemployment is forcing the Federal Reserve's hand, and they're expected to cut interest rates next week, which could be the final trigger for a massive market-wide rally. You need to see what's happening before the big move. In the latest video from Altcoin Daily, the channel examines the stark contrast between traditional financial advice, personified by Dave Ramsey, and the evolving world of cryptocurrency. Ramsey, a financial personality with over 20 million weekly listeners, recently called Bitcoin dumber than crap and compared it to Beanie Babies. The video points out this isn't new advice from him. He told people to sell in 2014 when Bitcoin's price was around $550 and repeated the sentiment in mid-2024 when it was near $50,000. The video makes a compelling point about the widening gap between traditional finance personalities and the accelerating reality of digital asset integration. The $7.4 trillion figure mentioned in the video is not far off. As of early September 2025, total assets in money market funds are hovering around $7.30 to $7.48 trillion. This represents a massive pool of capital that remains on the sidelines. Meanwhile, Bitcoin is trading around $110,000 to $116,000, and Ethereum is consolidating near $4,500. This price action shows resilience and growth far beyond the Beanie Baby comparison. In the latest video from CryptoRover, a historical signal on Bitcoin is flashing, which has previously indicated exponential price increases. The video points to a bullish crossover on the stochastic RSI while the indicator is in the oversold region, a pattern that has historically led to significant price rallies for Bitcoin. For instance, a similar signal in August 2023 was followed by a substantial upward move. The presenter notes that this signal is appearing again. The analysis in the video leans heavily on historical chart patterns and technical indicators, which can be useful but aren't always foolproof predictors of future performance. The current market is showing some interesting dynamics. As of today, Bitcoin is trading around $115,000 to $116,000, and Ethereum is hovering around $4,600. In the latest video from the Crypto Tips channel, the host explains how to avoid the common mistake of buying Bitcoin at the peak of a market cycle. He points out that the urge to buy is strongest when there's widespread euphoria, media hype, and social media is buzzing, which is often the riskiest time to enter. The video references historical examples like the 2017 peak at $20,000 and the 2021 high of $69,000, which were followed by major corrections. Instead of trying to perfectly time the market, the host suggests paying attention to behavioral patterns, like when everyone suddenly becomes a crypto expert. He also mentions that on-chain data, such as the MVRV ratio and the movement of coins from long-term holders, can provide clues that a top is forming. The best times to accumulate Bitcoin have historically been during the boring periods of bear markets when sentiment is low, citing the lows of 2015, 2018 to 2019, and 2022 as prime examples. The video advocates for using a dollar-cost averaging strategy to build a position patiently, removing emotion from the decision-making process. Ultimately, the message is to build conviction based on understanding Bitcoin's long-term value rather than chasing hype. The video's advice to remain level-headed is particularly relevant in the current market. As of mid-September 2025, Bitcoin is trading around the $115,000 to $116,000 range after a period of consolidation. The crypto fear and greed index is in neutral territory, hovering between 40 and 53, suggesting the market isn't driven by extreme emotion in either direction right now. This contrasts with the euphoric conditions the video warns about. On one hand, institutional interest continues to grow, with BlackRock prioritizing Bitcoin due to regulatory clarity and firms holding over 12% of the total supply. There's even speculation about the U.S. government announcing a strategic Bitcoin reserve this year. However, September is a historically weak month for Bitcoin, and after a 6.5% decline in August, some caution is warranted. The MVRV's C-score, a key on-chain metric mentioned in the video for spotting tops and bottoms, currently sits around 2.3, which is not in the extreme overvaluation territory seen at previous cycle peaks. This suggests that while the price is significant, the market may not be overheated from a historical perspective. The regulatory landscape is also becoming clearer, with U.S. agencies like the SEC and CFTC working to harmonize rules, which could further boost institutional confidence. This environment of steady institutional adoption, neutral sentiment, and clarifying regulations aligns with the video's theme of looking for solid fundamentals rather than reacting to hype. In the latest video from Lark Davis, he talks about the strange state of the economy where rising unemployment is paradoxically creating a bullish environment for assets like crypto. The U.S. unemployment rate just hit 4.3%, the highest it's been since October 2021, with only 22,000 jobs added in August, far below the expected 75,000. While AI is taking some jobs, as seen with Salesforce cutting 4,000 roles and a Stanford study showing a 13% employment drop for early career workers in AI-exposed fields, the bigger issue is economic uncertainty tied to the Trump administration. Despite the weak job market, the GDP is surprisingly strong, growing at 3.3% last quarter with a 3% estimate for the current one. This is happening because money isn't disappearing, it's just moving. Instead of going to employee salaries, it's being poured into capital investments like AI, data centers, robotics, and energy. Big tech companies are in an arms race, with Meta pledging $600 billion by 2028 for these areas. On top of that, massive government spending, like a new bill set to add $3.4 trillion to the deficit over 10 years, is pumping more cash into the economy. This rising unemployment gives the Federal Reserve a reason to cut interest rates, which is expected to happen next week. This action will flood the markets with fresh liquidity, which will likely chase returns in assets like stocks, real estate, and crypto. The video points to gold heading towards $3,700 as a sign that markets are anticipating this, and historically, Bitcoin follows gold. The situation creates a tough environment for workers, but a potentially profitable one for those who own assets. The video's core idea that a weakening labor market can perversely fuel asset prices is playing out in real time. The August jobs report confirmed the unemployment rate ticked up to 4.3%, with job creation slowing significantly. At the same time, the Atlanta Fed's GDP Now model is forecasting a robust 3.1% growth for the third quarter, supporting the video's claim of a disconnect between Main Street and the broader economic output figures. The massive spending by tech giants on AI infrastructure is not an exaggeration. Companies like Microsoft, Amazon, and Meta are collectively planning to spend over $400 billion in the coming year on capital expenditures, largely for AI. This massive reallocation of capital from labor to technology is a powerful undercurrent. All eyes are now on the Federal Reserve's meeting next week, where there's a more than 90% chance of an interest rate cut. This anticipated flood of liquidity seems to be getting priced in, with gold currently trading near a record high of around $3,650 an ounce and Bitcoin holding strong above $115,000. The dynamic described in the video, where government and corporate spending props up the economy while the Fed prepares to inject more liquidity, creates a compelling, if unsettling, case for asset price inflation. In the latest video from Cowen, The discussion centers on Bitcoin's price movements and what we might expect as we head into October. He points out that September is often a month where Bitcoin finds a low point before rallying. Historically, we've seen this pattern in previous years like 2017 and 2020, where the price dips and then begins to climb, setting the stage for a new cycle high in the following months. Right now, Bitcoin is holding steady above the bull market support band, which is a positive sign. Ben Cowen's analysis of historical September lows for Bitcoin, followed by a Q4 rally, is a narrative many in the market are watching closely. Currently, Bitcoin is trading around $115,000, showing some stability after a dip from its all-time high of over $124,000. The crypto fear and greed index is sitting in the neutral zone at 53, up from fear just a week ago, which suggests that some confidence is returning to the market. A key factor that could influence the market is the upcoming Federal Reserve meeting on September 16th to 17th, where there's a more than 90% chance of a 25 basis point rate cut. While a rate cut is generally seen as positive for risk assets like crypto, the market's reaction isn't guaranteed. Some analysts, including Cowen, have suggested that a rate cut could, counterintuitively, trigger a short-term correction as the market may have already priced it in. In the latest video from Coin Bureau channel, Nick explains that the crypto market structure is a super important, yet often overlooked factor in how prices move. He walks through how things have changed from the early, hard-to-buy days of Bitcoin to today, where spot ETFs and user-friendly apps make it much easier for money to enter the market. Because of these structural improvements, he suggests the total crypto market cap could swell to somewhere between $6 and $9 trillion in this cycle. The video pushes back on a few common worries, arguing that the rise of many new altcoins isn't necessarily a bad thing, that spot ETFs won't stop money from flowing into altcoins, and that the market doesn't need stimulus checks to rally. The main idea is that the biggest thing holding back a massive bull run isn't a lack of money, but a lack of attention. Since people aren't stuck at home like they were in 2021, rallies are expected to be shorter and more intense, much like the 2017 cycle. Looking ahead, the video predicts that new U.S. regulations will pave the way for traditional finance firms to enter the space more directly, potentially leading to a future where the market is less about crypto-native companies and more about digital assets offered by big banks and exchanges. The video's core argument that attention is the new bottleneck for capital flow feels very relevant right now. The market has been choppy, with Bitcoin hovering around $115,872 after hitting highs over $122,000 earlier in the year. This aligns with the idea of shorter, attention-driven rallies rather than a sustained year-long bull run. We're seeing rapid rotations where capital flows intensely into one narrative, like Solana, which has seen a huge 19.4% gain this week to trade around $243 before moving on. This supports the video's thesis that easily accessible coins on fast chains are capturing the limited attention span of the market. In the latest video from CryptosRus, the host explains a surprising market rally. Despite a slightly higher than expected CPI inflation report, both traditional markets and crypto saw significant gains. This happened because jobless claims also rose, signaling a slowing labor market. Investors are taking this as a sign that the Federal Reserve will be more likely to cut interest rates. A rate cut is now largely expected for next week, with more anticipated in October and December. The host mentions that after an initial dip, crypto markets, led by Bitcoin, began to climb, with money seemingly rotating from stocks into crypto after the market close. Bitcoin is pushing past $115,000. Solana is nearing $230, with predictions it could reach $260 and then $300 soon. Ethereum is holding strong around $4,500. The video also touches on the idea that an altcoin season is heating up, with meme coins on Solana also seeing a bump. Finally, the strong demand for the Gemini IPO is seen as another positive sign for the crypto space, showing high institutional appetite. The market's positive reaction to negative economic data isn't new, but it shows how much everyone is banking on the Federal Reserve to lower interest rates. Currently, Bitcoin is trading around $115,500, showing some stability after its recent push. Ethereum is hovering near $4,600, while Solana is trading at about $247, continuing its strong performance. The anticipation for the upcoming Fed meeting is palpable, with markets pricing in a very high probability of at least a quarter-point cut. This sentiment is fueling risk assets across the board. The Gemini IPO, which was priced above its initial range at $28 a share and saw demand outstrip supply by 20 times, underscores the intense institutional interest in crypto. The stock even opened at $37 before settling around $32 on its first day. This, combined with significant inflows into crypto ETFs, suggests a strong undercurrent of confidence in the digital asset space, even as political pressure on the Federal Reserve creates a complex macroeconomic picture. In the latest video from Banter, the host gives a full tour of the KuCoin crypto exchange, positioning it as a reputable and secure platform for both new and experienced users. He mentions that the exchange serves over 40 million users across 200 countries and has strong security credentials, including a AAA rating, making it the sixth most secure exchange. The tutorial walks you through the entire process, starting with signing up using the special link in the description to get a $100 trial fund and a 100% cashback on the first $100 deposit. The video explains the mandatory KYC, Know Your Customer process, which involves submitting your ID and personal details, a standard for compliant exchanges. The video provides a solid, practical overview of KuCoin's features, which is especially useful for anyone new to the platform. Looking at the current market, KuCoin continues to position itself as a major player by focusing on security and transparency. They've consistently published proof of reserves audits for 32 straight months, with recent reports from July 2025 showing more than 100% coverage for major assets like Bitcoin, ETH, and stablecoins. This is a significant trust signal, especially in a market where users are wary after past exchange collapses. The platform's broad offering of over 900 digital assets remains one of its biggest draws for those looking for altcoins. In the latest video from Casey, she provides a step-by-step guide on setting up and using the Tangem hardware wallet. She explains that hardware wallets are the only way to have complete ownership and control over your cryptocurrencies. The video walks through the entire process, from unboxing the Tangem cards to creating a wallet, setting up backups with multiple cards, and creating an access code. Casey demonstrates how to add various cryptocurrencies like Bitcoin, Ethereum, and Solana to the wallet. A significant portion of the video is dedicated to showing viewers how to transfer crypto from an exchange, using Uphold as an example, to the Tangem wallet. She sends $50 worth of Bitcoin as a test transaction. The video also covers how to sell or swap cryptocurrencies directly from the Tangem app using services like MoonPay and Changely without needing to send them back to an exchange. Additionally, the video touches on the wallet's features for staking various cryptocurrencies, including Cosmos, Atom with a 16.47% APR, Solana with a 6.47% APY, Tron with a 3.3% APR, Polygon with a 2.87% APR, and BNB for a 1.3% APY. Casey also explains how to connect the Tangem wallet to DeFi applications like Jupiter on the Solana network using Wallet Connect. Finally, she discusses the security aspects of the wallet, including the option to generate a seed phrase, and emphasizes the importance of diversifying how you store your crypto assets. The emphasis on self-custody through hardware wallets is becoming increasingly relevant as the crypto market matures. The hardware wallet market is projected to grow significantly, from around $500 million in 2025 to over $2 billion by 2030, showing a clear trend towards users taking control of their own assets. This move is partly driven by the rise in crypto-related crime. with billions stolen in the first half of 2025 alone. Tangem's card-based, NFC-enabled system offers a user-friendly approach that could appeal to newcomers who might be intimidated by more complex devices. The current price of Bitcoin is around $115,671.12. Ethereum is approximately $4,628.08, and Solana is trading at about $246.98. With such high values at stake, the security of these assets is paramount. The staking yields mentioned in the video are attractive. For example, Cosmos, Atom. Staking rewards can be as high as 22% APR on some platforms. However, it's worth noting that staking rewards can vary, with other sources showing around 14.59% for Cosmos and approximately 1.91% to 3.68% for Polygon, Matic. Similarly, BNB staking rewards can differ, with some platforms offering up to 7% APY. The convenience of swapping assets directly within the Tangem app is a strong feature, but it's important to be aware of the fee structures of the integrated third-party services. The ability to connect to DeFi platforms is also a significant advantage, as it allows users to participate in the broader decentralized finance ecosystem without fee. In the latest video from DataDash, Paul Sampson explains that recent economic data, including higher than expected job losses and stable CPI, caused a quick dip in Bitcoin's price. Bitcoin dropped about 1% from roughly $114,500 down to $113,300, but the price recovered almost immediately. He describes this type of volatility around 8:30 a.m. Eastern, when data is released, as a typical whipsaw event that takes out both long and short positions. For the rest of the week and into September, the key level for Bitcoin to hold is around $113,000. If that support holds, he anticipates a move up to a weekly target of $115,000. The next major resistance area is around $118,000. Breaking through this could set Bitcoin up for a push toward new all-time highs of $130,000 to $140,000. He also looks at Avalanche, AVAX, noting its strong setup and breakout above $26. He sees potential for AVAX to move towards $54, then $61, with a larger target of around $98 if the market momentum continues. The video's analysis of Bitcoin's price action around economic data releases holds up, as markets often exhibit short-term volatility in response to news. The price levels mentioned are still very relevant. Currently, Bitcoin is trading around $115,671, successfully hitting the weekly target of $115,000 mentioned in the video. This shows strength and aligns with the view that holding the 113,000 support level was important. The August CPI data showed a 0.4% increase, with annual inflation at 2.9%, slightly higher than anticipated, which could introduce some headwinds for risk assets if it encourages a more cautious stance from the Federal Reserve. However, the crypto market sentiment is currently neutral but improving, moving away from fear over the last week. There's strong evidence of institutional interest, with spot Bitcoin and Ethereum ETFs seeing over $1 billion in inflows on September 12th. This institutional confidence, with some analysts expecting Wall Street to increase Bitcoin allocations, supports the potential for a move towards the $118,000 resistance. In the latest video from CryptoWendy, Greg Bell from the Hedera Foundation discusses his takeaways from the Salt, Wyoming blockchain event. He notes the strong presence of Hedera's ecosystem, from the foundation to builders seeking venture capital. A key topic was the increasing institutional adoption of crypto, with a focus on tokenization and AI. Wendy points out that Hedera seems to be building a powerful combination of AI, DeFi, and real-world assets, RWAs. A major example is Swarm's initiative to bring tokenized stocks like Tesla and Apple onto the Hedera network in a compliant manner, opening them up for use in DeFi applications. Greg also shares a bullish outlook on the approval of crypto spot ETFs this year, mentioning the variety of products in the pipeline, including basket ETFs focused on American projects. The conversation then shifted to the importance of the retail community, which Greg admits has been underrepresented in the Hedera ecosystem. He highlights the recent success of the Dead Pixel Ghost Club NFT project, which has seen trading volumes surpass well-known collections on other blockchains as a sign that retail engagement is growing and bringing a fun element back to the network. The conversation in the video captures Hedera's dual strategy, courting institutional players with enterprise-grade solutions while fostering a grassroots retail community. On the institutional side, the focus on real-world asset (RWA) tokenization is timely. The RWA market has seen explosive growth, with projections suggesting it could become a $16 trillion opportunity by 2030. Recent moves, like Archax launching a fund of money market funds on Hedera, show this is already happening. This aligns with major partnerships announced this year, including a significant collaboration with NVIDIA, EQTY Lab, and Accenture to use Hedera as the ledger for a new AI solution, which has helped bolster BAR's price. In the latest video from The Modern Investor, the discussion centers on the current state of the cryptocurrency market, highlighting the anticipation surrounding ETF approvals and widespread price predictions. A key point is the idea of a $1 million Bitcoin, which is presented not just as a sign of success for crypto, but as an indicator of a major crisis in the traditional financial system, particularly the collapse of the US dollar. The video references Galaxy Digital CEO Michael Novogratz, who warns that a rapid surge to $1 million Bitcoin would reflect a collapse in the US economy. It also touches on predictions from other figures like Arthur Hayes, who foresees Bitcoin reaching between $750,000 and $1 million by 2026, and Cathie Wood's even higher long-term forecasts. The host argues that the influx of institutional money from companies making purchases worth millions is a reaction to the declining value of fiat currencies. This movement is seen as evidence that these institutions see the writing on the wall for the current economic system. The video suggests that the devaluation of the US dollar is happening in real time and that the rise of Bitcoin to such high values would fundamentally change the global economy, benefiting those who hold Bitcoin. The video's central theme, linking $1 million Bitcoin to a US dollar collapse, is a narrative that's gaining traction, and for good reason. We're seeing significant institutional inflows into Bitcoin ETFs, with billions being poured in, which signals a growing belief in Bitcoin as a store of value. At the same time, concerns about de-dollarization are becoming more mainstream, with even major financial leaders acknowledging the trend. While the idea of a complete and sudden collapse of the dollar might seem extreme, the gradual erosion of its dominance is already in motion. This shift could indeed redirect substantial capital into assets like Bitcoin. The predictions from figures like Arthur Hayes and Cathie Wood, while sounding sensational, are based on these macroeconomic trends. The current market shows Bitcoin consolidating around the $115,000 mark, with on-chain data suggesting growing investor confidence. This period of stability could be the calm before a significant move, especially as institutional adoption continues to create a supply squeeze for a limited asset. The convergence of these factors makes the video's core argument a compelling one to consider. In the latest video from the Alex Becker channel, he argues that the crypto market is just entering the early stages of a major altcoin season set for Q4. He bases this on the idea that a huge amount of capital, which he states is $7.3 trillion, is currently held in money markets. As economic conditions shift, he expects this money to flow into riskier assets, creating a massive surge in the crypto market that will dwarf the small pumps seen so far. He predicts the real alt season will bring 20x to 30x gains on many projects. The video lays out a very bullish case for the final quarter of the year, pinning the explosion on a massive capital rotation from money markets. That core idea has some merit. Total assets in money market funds are indeed at a historic high, sitting around $7.3 trillion as of early September 2025. The big question is the trigger for that rotation. While forecasters do anticipate Federal Reserve rate cuts in the second half of the year, the timing remains debated with possibilities ranging from September to December. A delay could postpone the flood of liquidity he's anticipating. In the latest video from Jebb, he explains why a significant rally for Bitcoin seems to be on the horizon. The prediction made earlier in the week for Bitcoin to hit $118,000 is getting closer, with the price already reaching $116,000 and wiping out over $100 million in short positions. The analysis points to several technical indicators suggesting this upward move. An inverse head and shoulders pattern on the chart has a price target of $120,000, with the $118,000 level acting as a key point of control where most trading has occurred. Additionally, a Fibonacci retracement level reinforces the $118,000 target. Bullish signals from the MACD and RSI indicators further support this outlook. Jebb's bullish case is built on a combination of technical chart patterns and favorable macro conditions. Currently, Bitcoin is trading around $115,000 to $116,000, keeping his $118,000 target very much in play. The argument about institutional interest is not just talk. Spot Bitcoin ETFs have seen massive inflows, with a record cumulative flow just reached and another $642 million added on September 12th alone. This demonstrates strong and sustained institutional buying pressure, which aligns with the video's thesis.